So welcome everybody. My name is Geoff Green. I'm going to be your host for today's housing market update. Thank you for joining us. July 22. This year is cruising right along. Let me get my screen share set up and we will get you going on our information that we have here for you. So we're going to get to our panel in just a minute. And in the meantime, let's take a look at what's really going on out there, which is an economic slowdown and really a housing market slowdown as well. Things are changing, but we're going to guide you through it. No worries. All right. So even CEOs are fearing a recession, and 3/4 of them say that we're already there. And if we're not, we're going to be there within the next 12 to 18 months. So I don't think that there's any question that a recession is on the horizon if we're not already there. This is a good quote here. Throughout history, during a recession period, interest rates go up at the beginning. We've already seen that, right? Rates have shot up big time. But in order to come out of recession, interest rates are lowered to stimulate the economy moving forward. So historically, we have seen a repeated uptick in interest rates followed by lower interest rates. We don't know that that's definitely going to happen in our case where we are now, but at some point, rates will come down because it's just a free marketplace and that's how it works. So this is a really great graph. I thought this was cool. It goes all the way back to 1971. And if you're a guy like me who grew up and around the housing market, everybody, I've always heard, oh, I had my first mortgage was 18%, 16%. You're like scratching your head, like, could that actually be true? Like they had an 18% mortgage, but you can see here in this chart that in the early 80s, rates, it looks like 1980, between 80 and 81, rates were 18%, over 18%, almost 20%. So like maybe 18 and a half, 19% almost. So historically, you got to, check in with where we're at right now. We're actually at a very good level right now, historically speaking, really lower than any period of time, minus, from 2009, the great recession there, financial collapse. Better than any of those times. So that's where we're at right now. It doesn't mean that it's a good thing. I'm just giving you historical perspective. So we've had quite an uptick here. You can see where we're at there. And it doesn't necessarily mean that we're going to come out of this anytime soon. We're going to see rates decline anytime soon. But I think it's important to know that at some point during recessions, they're going to start to do some more rate modifications, which will ultimately put downward pressure on a 30-year fixed mortgage. And again, this is, you can see here the recession period, how long that went, and mortgage rates, what they went from and to, right? So it was 16 to 11, 18 to 13. You can see in the early 2000s, 7.4, excuse me, to 6.8. So not all that much, but still some. And then the Great Recession, you can see they went from 6 to about 4.9. And really, even this is also interesting here too, is the COVID recession, which, it was a self-inflicted recession, right? It went from 3.8 to 2.8. So, rates were historically low, lower than they had ever been since the 70s. And they had to come up, right? But obviously with inflation, everything else that's going on, it's just dramatic and it's fast. So that's why it's so shocking. So, over the past few recession, mortgage rates have fallen an average of 1.8%. So of all those different rows that you saw on that last slide, it's about 1.8%. So, and in many cases, they have continued to fall after the fact as it takes some time to turn things around. So that is true. I think there's hope that the recession will bring lower interest rates. Now, as far as the housing market and how recessions impact the housing market, this is a slide that we've shown the last bunch of times. And just because we're in a recession doesn't necessarily mean that the housing market has to collapse. And I also, I'm talking a lot about this with clients and agents and people that I know, because they're always asking me, hey, what's going on with the housing market? And my overall statement is, look, things are shifting. Things are definitely coming apart. We have some pain ahead of us, but this is very different than what we saw during the last financial crisis. I don't think anybody who really understands the numbers and what's going on can argue with that, because a lot of loans that have been written during this period have been solid. They haven't been for second, third, fourth homes, that sort of thing. Hasn't been a lot of subprime debt being issued over the last 10 years here. So I think we're going to see, Do I think that at some point we're going to see price decline? Yeah, I do. Not everybody will, as you'll see in these slides, agrees with that, but I do. I think prices are going to decrease at some point. But I don't think you're going to see anything like you see here in the 2008 block during that recession. Inventory update. I guess one of the great things out of all of this, right? So like offers being received are down, offers over asking are down, the number of sales is down. So a lot of key things are down, but the reality is inventory is coming back. So that just means more selection for people. And that's really a good thing, because at the end of the day, home ownership is the goal. And whether existing homeowners make a boatload of money or realtors and mortgage bankers make a boatload of money, that's not really what's important. I mean, obviously we need to make money, otherwise we can't survive and keep this industry going. But really what's important is getting as many people into homes as possible with and that they can afford, so that they're not getting themselves into trouble. So there has been a pickup in inventory that we've recently seen. This is Mark Fleming, chief economist of First American. But it's not from a big increase in new listings, but rather a slowdown in the pace of sales. Okay, fine, that's fine. But I mean, that fever pitch that we were in, it just couldn't continue forever. It had to stop at some point. And remember that month's supply measures the inventory of sales relative to the pace of sales, right? So it's the same inventory, right? So the idea is same inventory, fewer sales means more months supply. Okay, so fine, I agree with that. And you can see here that from January of 22 through May, the inventory really has been rising pretty significantly. It's been increased over a month. Now, what's considered a healthy, balanced market is 6 months of inventory. So we're still very much in a hot marketplace with low inventory at 2.6 months. So I expect this number to continue to rise over the next 12 to 18, maybe 24 months. So active inventory continued to grow. That means the active houses that are actually on the market rising 21% above a year ago. That's a big deal. In other words, we're starting to add more options, but the market needs even more before home shoppers have a selection that's roughly equivalent to the pre-pandemic market. That's Lawrence Yun, chief economist of NAR, National Association of Realtors. And here's a look at that. When you take a look from January through May, you can see that in 21, the active listing count was 359. So it was below, even in February below, and now it went above in April and way above in May. So that's a good thing. It means that there's just more inventory coming on the market as compared to last year. I think that you're going to see variances like this continue. One more quote by Lawrence: home sales have essentially returned to the levels seen in 2019. Okay. And you can check that out here, right? Like here's the seasonally adjusted annual rate provided by the NAR. And you can see back in 17, they closed out 5.5 million transactions. 18, it dipped down, 19, it dipped down. And right now they're projecting 5.4 for 2022. So it's still a very strong year. Historically, all of these were very strong years. 5.5 was a big number, a really big number before this came into effect. And then we had 21. So these are statistical outliers. It just couldn't go on that way for a long time. And we're projecting still a very big number for 2022. Okay, so the big question is, if you're a buyer, should you still buy a home right now? Well, a lot of people are trying to scare you. You're starting to see some headlines that are a bit scary. The cooling housing market enters into the great deceleration. Home prices decelerate as the housing market downshifts. Buying a home at the wrong time can backfire big time. Here's why it may pay to wait. Okay, that's the Motley Fool. So, a lot of people are pouncing on this as an opportunity to create news and get people to read what you're saying. But the reality is, and I think that this is the case in any market, is look, what are you going to pay for rent? Number one. And I can tell you right now, the rental prices are not decelerating. They are continuing to remain strong and even increase. And how long are you going to stay in your home? If you're going to stay there for a fairly long duration, it almost doesn't really matter when you buy. You'll make it up in the long run if you're there long enough. Your equity will come back to you if it decreases. Just keep paying your mortgage, keep working on your house, don't defer maintenance, keep up the shape of the asset, and get in the game. It's really important. So decelerating home prices do not mean depreciating home prices, right? So the idea is that yes, home prices are not appreciating as much, i.e. decelerating, but it doesn't mean that home prices are going backwards. They're not. So this is a look right now at the current projections, of which average, 8.5%, which is a huge increase, historically speaking. I mean, in general, 3 to 4% is a rule of thumb in real estate as to what you can expect your asset to increase by each year. So 8.5% is a big number. Now this was December to December forecasts as of Q2 and 22. So these numbers are a little bit outdated as opposed to what you see. So you see the variance between the 8.5 and the 9.3. But needless to say, most economists are still projecting that prices are going to increase, not decrease. I'm not so sure about that, but what do I know? I'm just one little guy in the New York metro area. All right, why is my slide not going? Here we go. So the root issue, this is by Dave Ramsey. You guys know him. He's a personal financial guy. The root issue of what drives house prices almost always is supply and demand, right? And that's definitely what we've been seeing lately. Now interest rates affect that. Okay, when interest rates go up, guess what? That means fewer buyers. And that's exactly what's happened. It's just affordability has driven people out of the marketplace because now with rates being so high, they're just out of the game. So that means less buyers for homes, or they have to, downshift their price range, and maybe they don't want to do that. So another factor here is single family housing units being completed by new construction. This was one of the problems that led to where we got to the inventory problem, is that it dropped off during the financial crisis, as it should have, right? Because, I mean, if you're a builder spending money and there's no one there to buy, why would you keep building? So the financial crisis really shook the core of the construction industry, and it was ramping up to where we see here in 21. We'll see how that continues. But needless to say, even the 21 height of the last, decade or so, more than a decade, really 15 years, is still pretty low, historically speaking, right? Like if you just take your eye and go over here, it's still at a relatively low number. Now, why is that important? Well, let me read this quote and then I'll come back to it, because we're going to talk about the population growth. Experts don't believe the market is in a bubble or crashes in the cards like during the Great Recession. I'm in that camp. The nation is still suffering from a housing shortage that has reached crisis proportions at a time when many millennials are reaching age when they start to consider home ownership, right? And this graph I really love, and I've been, pouncing on this now for a bunch of months, and I feel like not enough people are recognizing this fact right here, which is the largest segment of the population is now ready to buy a home or to move up into a bigger home because their family is growing. And that is just a fact of our population where we are here in the US. And I would assume that this trend is fairly similar around the world. So, when you think of supply and demand forces, there's just a huge demand, on our hands right now. And what's interesting, though, is that, this large segment is going to continue to move along. I mean, they're going to be in the home ownership category for the next, 30 years at least. So it's a huge segment of the population. But what's interesting is now you start to see a smaller population coming in. So this could population growth could very well just drive the housing market for many years to come. And, I think also the fact of the matter is a lot of people, during the Great Recession, were living with their parents, saving up money because maybe their jobs weren't there. But now they're ready and they're hungry and they want to go out and they want to buy a home, which is a good thing. So I think the population growth needs to be something we keep an eye on, and we will. Okay, so that's it for my presentation. Just some housekeeping items, and then we're going to get to our panel. The next housing market update is going to be August 19th. And a thank you to NewOp, Business Opportunity Exchange, for sponsoring the housing market update always. You can check out a live feed of real estate and mortgage referrals at newop.com. Okay, so let's go to our panel. Unfortunately, Christy Anderson's not here to join us today. She had something else that was pressing to deal with, so we're not going to see her. But we do have Pete Mallon and we do have Keren Gonen. So welcome, Pete and Keren. Thanks for being here. Keren, let's start with you, and then Pete. Lots to talk about on the mortgage front, so we'll round out the conversation right there. Wow. So Keren, I assume that you're seeing a shifting market here, right?
Absolutely. Yes, we are.
Okay. And it's really been remarkable. Like if you were to watch, the housing market update from 3 months ago, you would see different numbers, you would hear different things. It's really been changing in the last 60 to 90 days. Would you agree?
Absolutely.
Yeah. So what are the biggest things that you're seeing, boots on the ground stuff, that make you feel that this market is really shifting?
So what we're seeing is we're no longer seeing the crazy offers of 20, 30, 40, 50,000 above asking. If a house is priced properly, it does still sell immediately. We don't have what we did before where you list a house and you have 20 offers, or you have an
Right.
open house and there's a line out the door. That we no longer see. We do see good houses properly priced, still selling very
Hmm.
quickly, possibly some bidding wars, but not the exorbitant amounts
Hmm.
of over asking that we saw before. But good houses are still selling.
Yeah, I mean, I can say from my own experience in this industry, because the vast majority of the transactions that I did were during the Great Recession, and it was hard to sell a home back then. But even then, homes that were well located, maintained well, and priced right would always sell. And it
Right.
wouldn't take that long for them to sell. They would sell, but the price is really important. The condition is important, and so is your location, you know? And
Absolutely.
during this, I think, boom, like location didn't matter so much, and condition and prices were all over the place. But it's really important to get serious about price right now, right? As a seller.
Absolutely. So you can't go above and beyond and say, I'm not doing anything. That no longer
Right,
works.
right.
It's definitely about being priced properly. And like you said, the condition. If your house is not list ready and you think you're going to list and sell right away, those days are long gone. That's not
Yeah.
going to happen.
Yeah, yeah. I mean, if you're somebody who's, hasn't sold yet and you were thinking about it, the 2 year crazy market is behind us. The peak is behind us. There's no question about that. And
Definitely.
it's not like it's not going to get that way, hopefully ever again, right? Because I don't want to ever see another pandemic. I mean, honestly, that was an insane market. Us in this industry, we did well, but honestly, that I don't think that was really that healthy, quite frankly. Um, but I think the reality is it's important as a seller to be realistic with where things are, and you need to listen to your realtor, um, to make sure that you price it right and really take a look at the inventory that's out there, right, Karen? I mean, you got to look at the comps, you got to study it.
Absolutely. So before, the comps really meant nothing because the market was completely topsy-turvy. It made absolutely no sense from a professional point of view. You could ask for $1 million and probably get it. We can't do that anymore. We definitely need to run the comps. We need to run the comps in the last 3 months rather than 6 months because the market has changed over the last 90 days. And it is imperative to work with an agent that does this day in and day out, as
Yep.
opposed to a lot of people that jumped into the market because it was so insane and took advantage of making money in a good money market, because no matter how many agents you had, there was still space for more. There were so many people shopping. That's no longer the case. Inventory is up, so it's not as if you have to rush right away like you did before. But working with someone that knows the area and somebody that does only this for a living is imperative at this point.
Yeah, no doubt about it. And I think the other thing is too, if you're already on the market and your house is not selling and you're not getting showings at a minimum, you have to adjust your price.
Absolutely.
Again, most of the transactions I did was during the Great Recession, and it was really hard to sell homes back then. And it literally comes down to price. You got to find the right market price for your real property, and it will sell because there's always a buyer out there. And you can't
Absolutely.
be afraid to make adjustments. A lot of people are afraid to downward adjust. The bigger risk is leaving your home on the market and allowing it to become stagnant.
Right.
So I highly recommend that, you be aggressive with pricing and make sure that, when you price it, when you do that reduction, that you're getting the activity that you think you did. And if you didn't, you probably need to do another reduction, and you got to keep
Exactly.
going until, the marketplace absorbs it, because it will. There's plenty of buyers out there. They're all looking. They're just being very cautious right now because it's a hell of a lot more expensive this year than it was last year to own a home,
Sure
because of
is.
interest rates. you know? So the next thing, Karen, that's going to be interesting to keep an eye on are the appraisals. I think we're going to start to see issues with the appraisers being willing to appraise homes, because anytime, you know, you're shifting in a marketplace, they get a little skittish for good reason, you know,
Right.
the home that they're
We
appraising.
haven't, I
Go ahead.
haven't seen that yet. I haven't had an appraisal that did not come in on point. But that could be a direct correlation to the fact that I price, or that I ask when I make an offer, I make it to a place where I know it's going to appraise, or I tell my clients, you're going to have to absorb that gap if you want the house.
Right. Yeah, exactly. All right, cool. So Pete, let's transition over to you and talk about mortgages. This has really been a wild ride, right? I mean, man, rates have just shot. I don't know that they've ever shot up that fast, right?
They went up pretty quick. They came down a little bit again, though. Okay. We're back in the fives with the conventional,
Yeah.
and we can get to fours in FHA right now. But
Okay.
what you guys say about price is very important. It controls everything. If you have the right price, then FHA comes back into the market too. Okay. FHA sort of was pushed out because people couldn't get seller concessions, because houses were selling for more than it appraised at. So if it doesn't appraise, you can't get the extra money. So that'll affect the buyers too. As far as the way the rates are going right now, they're saying the rates are going to go up. Okay. But generally speaking, when they raise the rates, it doesn't always affect the mortgage rates. Okay. The rate that they're moving is not the mortgage rates. The mortgage rates are affected by it somewhat, depending on the yield. I think you guys know that. What's happened that I see now is, if you don't mind me just throwing a little bit of real estate into this because of what's been controlling us.
That's why we're here, baby.
The big push, in addition to the pandemic, was people realizing because of the pandemic, they can work from home. I had a lot of buyers who worked for Facebook and worked in Manhattan, didn't have to work there anymore. So they're buying here in Orange County, they're buying in Pennsylvania, they're buying in the Adirondacks. People are working in the city and buying in the Adirondacks. So the Adirondacks were going crazy too. Now, the pandemic is sort of let down a little bit, and people walk, not wearing masks anymore. So the people that were going to make the move have probably made the move. So that's those buyers. The other thing is the rates going up. It certainly hurts some people. Some people who thought they could afford 400 now can only afford 350. And that wasn't happening with those houses. And once you're looking at 400, you don't want to buy a $350,000 house, right? You want a nicer house. The other thing that I think is going to affect us big time is the foreclosures. Right now, the banks are starting to go after the people that have been laying in their house for 2 years, okay, or whatever, without paying, because there's equity again, because of the market, okay? Now the banks are going to go after the houses with equity. Once they go through that, then you're going to have foreclosures on the market again, and that's going to increase the amount of houses.
Inventory, yeah.
So I think those three things are kind of big also. As far as what to look, because I've been in this business 30 years, and I've been through it as a realtor with you in the wonderful recessions that we had. What I noticed then and what I'm noticing now as a mortgage person is that the way to really see what's going to happen to the rates is to watch what the adjustables do. Okay. What you have is in 2000. Oh, geez.
You're still with us. You're still here.
We're getting we're having
a little power spike there. You're good though, man. Keep rolling. You're good.
Okay. So what I saw in those days was when the 10-1s and the 5-1s became lower than the 30-year fixed, that's when you knew the rates were going up. Okay, we're definitely going to stay up. Right now, if you look at the 10-1s and 5-1s, okay, you know what they are, of course, right? 10-year fixed.
Explain it. Yeah.
Okay. And 5-year fixed. Okay. Well, right now they're the same rate as the conventional, the 30-year fixed. There's no reason to get them. But when the rates are in the 7s and they stay in the 7s, you'll see 10-1s be 6%, 1 point difference. And that makes difference. And that's when they tell you sort of that the rates are going to stay up there for a while. When the banks start hitting their adjustables, their 5-1, 7-1, and 10-1s, when they start coming down in the rates, that's when you're going to see that probably the rates are going to stay where they are for a while.
But what you're saying is that right now they're all even.
Yeah, right now.
So therefore, you think that rates might actually come down.
They
because-
did, they have. I mean,
Right.
we're down to, we got 5.5 the other day, okay,
Yeah.
for conventional. And that was over 6. It was 6 1/8 at
Right.
one point for
Right.
750
So
credit.
there's a
score,
half a
500.
point really in the last month too, it's just
Yeah.
in 30 days time that happened. Yeah. So,
Yeah.
yeah,
That's
it's
the
interesting
difference.
too. I mean, gas is kind of settling down a little bit too, it was on the rise and now it's kind of come down a little bit. You see it at the gas pump too, so.
See, there's a lot of people who say a lot of different things.
Yeah.
But then you watch what they do, okay? And when I
Mhm.
was a buyer's agent, there was a time when 10-1s, when the interest rate was 7 1/4, I can get 10-1s for 6%.
Hmm.
And they stayed at 7 1/4, 7 1/2 for like 3 years.
Hmm.
Okay. So I knew at the time that's what was happening. So I was telling everybody get a 10-1. You're going to be in the house for 10 years.
Hmm.
Just to add to what you said before, you mentioned about how long you're going to stay in the house right now.
Hmm.
So the question I would ask is, are you going to be here for at least 10 years? And can you afford the price? If that's the case, it really doesn't matter, right?
I agree with that. That's exactly my point. If you're going to be there for a decade, it doesn't really matter because, even if it doesn't even matter your interest rate now, if you can afford it, right? Because rates will come down, you can refi, and you can play that refi game as well,
Well, yeah, well, that's the thing. If you're going to live there for 10 years, big part of your life, right?
Yep.
Then you'll have paid it down enough that when you have to sell, even if
Yeah.
the market corrects itself, you won't bring money to closing, but you enjoyed the house, you lived there.
Yeah.
Okay.
And you didn't pay rent.
Right.
And you got an interest deduction on your taxes and all these other things that you can get,
I agree with you 100% on
Yeah.
that. Absolutely.
Yeah. And most importantly, you control where you live.
Right.
You don't have a landlord that's going to come in one day and raise your rent by $300 a month or
Right.
decide to sell the building and now you got to go find somewhere else. So there's a bundle of benefits to home
And
ownership.
think of this way too. How good is an appraisal for? 4 months. That's it.
Mhm.
Okay. So if it appraises today for 400, doesn't mean 6 months from now it's going to appraise for 400. So
Mhm.
really, like you said before, can you afford it? And can you live there for a bunch of years? If
Mhm.
that's the case, the appraisal is just a formality for the bank.
Irrelevant. Yeah,
Okay?
I totally
Now,
agree.
about appraisals now, what we've been able to get now because of these stupid markets, and I say stupid because it's been crazy,
Yeah, it has been.
we're getting a lot of appraisal waivers. Okay.
Mhm.
The past week, I got 3 where we're doing loans where we got the appraisal waived.
Mhm.
So it makes the buyer stronger because they don't have to worry about a gap.
Mhm.
Okay. The appraisal's waived. So in adding to what Karen said before was that the appraisals were coming in so much now with so many comps, the banks are now doing AVMs. Well, actually, it's not the bank, it's Freddie and Fannie.
Mhm.
They're the ones who let you know whether you can waive it or not. But because of the houses that have been selling on the market for higher numbers, now you got somebody buying a house with 20% down, they're waiving the appraisal.
Mhm.
So that's happening too. So, I mean, just add that.
I have to think though, there's those appraisal waivers are going to come to an end,
Oh, yeah.
in relatively short order as this market is shifting because now the banks have to be a little bit more careful.
Oh,
you know?
yeah, yeah.
Yeah. Yeah. So,
Absolutely.
okay, great. So listen, let's wrap it up. We're already at 11:33. I really like to keep the housing market update to 30 minutes or less. So we're kind of at that threshold right now. I want to go ahead and just share the contact information of our panelists one last time before we sign off. And thank everybody for being here. Really good information. And we'll see everybody next month in August for the next housing market update. We'll see what's going to happen with rates and everything else as time goes on. Thanks for being here.
Thank you.
All right. Take care, everybody.
Be well.